Okay, hello everyone. I'm Kevin Liu. I'm a first year pursuing a bachelor's of science in business administration with a concentration in ITM, and I'm minoring in business and computing through the Denning T&M program. One of my stocks is Arcbest. Arcbest Corporation is a freight transportation and logistics service company. So what they do is they have an asset-based segment and an asset light segment. The asset-based segment transports commodities and a bunch of other miscellaneous products through their trucking services. The other segment provides like expedited freight transportation services and logistics services, which would be the asset light part. And there's also a bunch of other like subsections of ArcBest. They, for example, FleetNet segment provides roadside repair solutions. So they have a pretty diverse product mix. But the company was formerly known as Arcbest Corporation, and it changed its name to Arcbest, and it's still headquartered in Arkansas today. So moving into the model itself, so a couple things. First and foremost, the current like price is around $104. It's a big uptick from last year, where the last video that was made for this stock by the last person who worked in this VIP, the stock price was around 60 something dollars, and now it's obviously gone up really high. But we come to the conclusion that it's actually overvalued, and I'll go through a couple of reasons as I explain kind of the calculations. So this year you'll see that there's a pretty significant decrease in revenue year to year, and that continues a trend. The I guess revenue decrease is smaller than the past couple of years, but the industry in general, along with the manufacturing industry, which is one of their largest clients, have both kind of run to the issue with a lot of market softness, especially post COVID, and as you can see, like reflected here, and that it's only like pretty bad right now in first quarter, as the like it's a bad quarter for shipping and production in general, according to the conference call. Now, a couple things for our model. So for revenue, we do believe that the revenue can go back up. They have started diversifying their like they made huge capex investments over the past couple of years, and they are planning on, and through those they have new technology and they're taking market share, i.e. they're getting more sales, although the like our projections are still relatively like controlled because of those um increased sales being translating to less revenue and less operating margin, which is also reflected here. We think that operating margin will go up kind of slowly, and we can go up to the model here, and I'll explain some more things. So some other calculations we made were dividends paid. We calculated a rate of like increase around 0.038 by finding the average rate change for the past couple of years, and that keeps a relatively like fair amount of dividend change, or dividends paid, I mean, per year. And it's the same story with the unit repurchase. So they're on a current multi-year repurchase plan, and my projection is that since they are kind of making this commitment to lower the capex stuff costs, which I'll talk about later on, and more specificity, and the debt to like EBITDA ratio is well below the S&P 500. Their focus will probably be on repaying their dividends or repaying their shareholders, and for that reason, I'm just going to simplify it and assume that they're going to spend most of their free cash flows on the unit repurchases. Now, I'll go explain the operating margin some more. They have had lower operating margins as the operating expense actually increased and revenue per shipments decreased. Some other things are like capex percent. As I was mentioning kind of earlier while describing our debt, the capex percent is going to be down. They projected it to be somewhere around 150 to 170 million per year, and part of that just like they've realized they have enough substantial investments in capex, and they want to keep it below the like 4 to 5% range. I think it was, yeah, below 5% according to their conference call. Now, for depreciation expense, I projected it to be a tad bit higher than it currently is, at around 4.2%. And that's because of a couple things. First, last couple years they invested a lot into capex, as you can see reflected here, and all that stuff will be increased depreciation expense, along with the fact that like we're just sold straight up that their depreciation expenses will be rising the next couple of years. So yeah, young fleet and rising depreciation expense. Now, through the model, we can see that the projected intrinsic value from doing the cash flows here is around 85.8, and that means that there's a 18% downside. These are all pulled from Yahoo Finance and or the professor from NYU, and therefore we think that Arcbest is probably a bit overinflated right now, and we should probably sell. I'll go through a couple more stats and I'll explain the current like earnings presentation and some key statistics from the conference call that are relevant to making a decision. So first, we have the market cap at around 2.2 billion, which I think is an increase from the last couple of years because this is the peak of its stock price I think ever, and the forward PE is about 11.68, which is reflected inside the model. The dividend yield is around 0.48%, and the 52-week range is 55.19 to 112.92. The beta is around 1.5, so it's not super risky for a transportation company compared to the market. And moving into like the key comments from this year, 2025 quarter four. So first and foremost, there's a 973 million consolidated revenue, which is a 3% decline year over year. 14 million of non-GAAP operating income, which is down 66% from last year, according to the conference call, which is very substantial, and that's kind of one of the reasons why we think that there's a lot of downside to investing in this stock right now. Some investors online have talked about how they believe because Arcbest is taking market share through the revenue growth, that later on it'd be like a good investment, but we're just being conservative here and going purely off the DCF model and just assuming that like the manufacturing industry and transportation industry like broadly will continue to be kind of soft, and for that reason we're just kind of the safer play is just assume we'll be going down. For the asset-based part, they made 649 million in revenue with a 96.2% operating ratio, so that's actually quite good. But the asset light part was 354 million revenue, and that's down 5% year over year. They stayed pretty committed to return to their shareholders. So there's a 86 million returned over the past couple of years, or over the last year, via dividends and repurchases. And there's around, as I was mentioning earlier, like their liquidity is really good. It's around 400 million liquid assets available, and they have a really good net debt to EBITDA ratio that's like well below the S&P 500 average. And finally, as I mentioned in my projections, they're planning on reducing capex to be below 5% of revenue, and they're projecting that to be around 150 to 170 million in the yearly like capex expense, and that's pretty well reflected in our projections here. You'll see that we're below that 5% target, and our projected capex, up here is around that range, in the 150 to 170 range, and it gets a bit higher like 5 years on the line, but that should be fine. And you'll see like it's not like a terrible investment. It's just a bit risky, and we think there's a potential downside. That's kind of the TLDR of this presentation. And yeah, earning presentation is attached here, and that should be the majority of it. So the optimistic view is that the like market share increases from Arcbest will result in increasing stock price, and that's why the stock price is actually higher right now. But the like financial portion of it, after making all of our assumptions from the conference call, indicates that it's probably a bit inflated right now because of the strong optimism. And our approach is that the most conservative and safe approach would be to sell and avoid the potential downside. Thank you.